It's been a long, stalwart of those, very steady performer, a nice solid business.
What's the dividend?
I think yields about just shy of 3%, and there's opportunity to accelerate that. I think this business could be delivering upgrades in the current year. I think there's the potential for it. I think it'd be in good shape.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello Chris, good to see you again.
Hello, Lee, and you?
Welcome everyone with another jam-packed episode covering subscription-based businesses, Greggs, Premier Foods, Nichols soft drink, Science in Sports. We've got a couple of AIM takeovers, but before we dive deep into all of that and much more, of course, you've been quoted in the Financial Times just recently for a letter that you sent to the London Stock Exchange.
Yes, yeah, as an investor in UK companies, we're just a bit frustrated, and I thought it was about time I expressed my frustration to the LSE. So we sent a letter to Julia Hoggett at the London Stock Exchange and essentially asked her to get the marketing act together. What are they going to do to energize the London stock market and gender more interest in it? I urge anybody to go onto the London Stock Exchange website. Just go on there, the main page, and then make a comparison of that to what the NASDAQ stock market offers if you go onto their main page. Ignore companies or anything like that. Just go simply, and you can see the difference staring at you in your face between the dynamism and the lack of marketing of one compared to the other. And it just frustrates us. I think they should be doing more, and the London Stock Exchange, that is, to encourage people to find out more about the companies that are listed. Sadly, I don't think they're really that interested. I think they make so much money from other avenues. But anyway, that's what we have asked them to have a look at.
Did they respond?
No, not yet. I'm waiting for a reply. It was a formal letter. I thought we'd go old-fashioned, not an email, a nice formal letter, hard signature, all good stuff.
Yeah, we'll keep the audience
Yeah,
updated.
if we get, yeah, that'll be good.
Yeah, great stuff. Should we start off with gold then, that has just made all-time highs?
Yeah, it's extended its rallies, record-breaking rally. So it's good for those gold buffs out there. I'm not a fan. It's always been dead money. It's not income producing, but it's always been a sort of safe haven, and they're riding high. And a lot of companies are going to be benefiting, notably the miners, gold miners, pawnbrokers in the UK, big buyers of gold. They're going to be doing nicely, and we've spoken about some of the UK pawnbrokers before. So yeah, gold is going to be a beneficiary for those categories.
Another one as well that's just recently made all-time highs. Bitcoin touched on 69,000, broke the previous 64,400 set in 2021. In all honesty, are we actually surprised to see gold making new highs? S&P's just made new highs. House prices are at new highs. Bitcoin, new highs. It's like
London Stock Exchange not at new highs. London stock market, sorry. What I think is ironic, gold safe haven, relatively boring, traditional, Bitcoin, the new investment kid on the block, super speculation, not underpinned by government, central government. I find the irony of the two, and both are riding high. And going back to the lack of interest in equities, UK equities, because they're not exciting enough. As we've said before, people are just drawn to Bitcoin. That's what they get their thrill from it. And this is probably as a result of these new funds that have been rubber stamped by the SEC. So probably not surprising, but yeah, that irony with gold and Bitcoin flying high.
Speaking of another all-time high as well, Nvidia just become the third most valuable company in the world and one of the ultimate stocks portfolio as well.
Yeah, well, the Ultimate Stocks portfolio bought into it in 21. This is Investors Champion's Ultimate Stocks portfolio, and it's been doing well. Well, it fell to begin with in 22, then it's come absolutely flying back. It's now third most valuable company, and it's been a great contributor to our Ultimate Stocks portfolio. The stocks portfolio was up 27% in 2023. It started this year in good shape as well. And we rabbit on about high quality companies. And what do we mean by those? And these are big businesses. So the median market capitalization of our ultimate stocks are 147 billion. So we got some real giants in there but they're all multi-billion pound companies, medium 147. So they're all big. And most people think big companies, they're not going to grow at all. They're not going to grow very fast. But these things you've mentioned, Nvidia, are absolutely flying. In terms of quality, their average return on capital employed of these companies is 29%, which is way above the market. Operating margins that these companies are generating But it's not just the quality, it's the way they're growing as well. And compound annual growth rate over the last 3 years has averaged 16% and earnings growth 23% over the 2 years. So they're growing very fast with quality bases and they're reinvesting at very high returns and capital. What this portfolio is all about, really. Some are much higher than others. There are a lot of familiar names that people would be aware of.
It's a portfolio of 25, isn't it? What's 5 companies that most people
We won't give
so
everybody away. I'll give you three. We got Nvidia's one. You got there. You got Microsoft is another. And at the more, shall we say, mundane end of the scale, we got Unilever as well, which is a
Hmm.
very big company. We've been sitting on that. It hasn't been a big performer. It hasn't driven it, but we think it will come good. We think it's got a good chance. New management as well. I'll chuck out one more. One more. I'll give it the fourth, sort of way in between the two. We've held Sage Group for a while as well, the accounting software company. And we're going to come on to the benefits of great subscriber businesses. And Sage has turned into a great subscriber business. And a lot of people had fears about Sage. It was really late on the move to a subscriber growth, but we kept with it. And that even Sage was up 50% last year, the shares. And it's a UK listed company. It stayed on the UK market, based in, or headquarters are in Newcastle. Yeah, so it's been a good story and worth following. And we stuck to our guns where certain other well-known managers who will remain nameless decided to bail out, but we like Sage.
Yeah, for £90 a year, you can have access to all the updates, all the reports on these companies as well. So it's not a great deal, is it?
It's not a great deal, and you see some great stocks. We just changed one, so I won't reveal the change here, but we just had a new stock in there. We felt it was time to get rid of one of the legacy positions, and we've just got a new portfolio holding, which should excite people. Again, not a very well-known name to UK investors.
I'd tell you what I'd like to do. If enough people either email or leave a comment and just say, I'd like to know how Chris analyzes and selects his stocks for Investors Champion, we'll do a special podcast episode just on that. And we'll dive deep into how did Chris discover Nvidia in 2021? What was it that stood out to Chris so that he could pick it for the portfolio?
I would say I was a bit late, but better late than never, as it's turned out.
Even the one that you just added now, just recently, it'd be really good. So if the audience, if you're listening, send Chris an email, Investors Champion, or leave a comment, and we will do a special episode dedicated purely to how Chris finds these stocks. Is that Chris? Have I just
Yeah, it sounds good to me. Absolutely.
perfect? Should we move on to the UK main market then?
Growth in the UK main market, I think, from a very unlikely place. I think it's amazing, and you can find it. You just have to look. And Greggs, who'd have thought Greggs would have been a star performer? But look at the share price over recent years; done really well. This business has been around a while, and it's still growing strongly. It expects to open 160 new shops this year, adding to 145 that it opened in 2023. It's got just shy of 2,500 shops at this year end after opening 220 new ones and 75 closures. So it's unlike McDonald's that we've spoken about before. Greggs, well, you don't see many closures of McDonald's, but Greggs has more churn, I think, in its portfolio. Yeah, sales are still growing strongly, like for like, up 8%. And what I thought was amazing, its positioning as well in the food to go market. While its share of the food to go breakfast market, again, this is a bit alien to me because I like my breakfast before I leave home. But the food to go breakfast market its share rose to 19.6%, making it the market leader. So those people that want to, leave home and want their breakfast before they get into work, Greggs is up there and the market leader now. It's staggering, but who'd have thought it? A fairly staid seemingly business which has been around for so long as Greggs.
It's incredible, isn't it, as well? Because we talk about companies and innovation, and we mentioned Howden's, a simple innovation of sending carcasses out instead of flat packs for the kitchens. Here, Greggs has identified an area of breakfast to go. Who would have thought that people would actually go out and buy breakfast on the go? It's just
I know. It's
traditionally we've always ate breakfast at home, haven't we? But
yeah.
here, Greggs identified that space and went after it, and now they're the market leader.
And I still do. I still like my breakfast at home.
Yes,
But return on capital, back to one of the quality metrics we look for, return on capital of 26% is great. That's really great. What you want to look for, really.
And when were they founded, Chris?
1939 first established. I think it's the heirs to the founder that really drove this, and more recently, non-family members. I think it was started by Greg originally, but I think 20 odd years ago or 15 odd years ago, some outside management have really energized this business over the last decade or so.
Yeah, it's incredible, really, isn't it? Because with the amount of stores that they're looking to open up over the next few years, it's almost a growth play, isn't it?
It
In
is.
in the
It's
sausage
still.
roll market,
What I
food
struggle
food
to
market.
see, sausage rolls, vegan sausage rolls,
Yeah.
what I struggle to see is that it growing internationally, though,
Mm.
unlike, shall we say, a McDonald's or a Starbucks, where I
Yeah.
can't see it's resonating well in certain European markets, shall we say.
Spain, France, Italy. Are sausage rolls popular on the
Uh,
continent? I'm not too sure.
I'm not convinced it's going to go.
But
They're going to go down very well.
but is breakfast to go going to become popular on the continent?
Oh, I hope not. But
Shall we move on to another food producer in Premier Foods?
yeah, it's a more a food producer, this one. It's assembled quite a lot of, you call them iconic UK brands. It's got Mr. Kipling, Bisto, Oxo, Ambrosia, to name a few. It's got a lot of other brands, but these are very UK-centric brands. You won't, I doubt you'll see many of these in overseas markets. But yeah, the big thing with this Premier Foods is it's managed to rid itself of the burden of its largest pension scheme, which is massive. I think it's got a 3 billion pension scheme. Bear in mind, this business is a market cap of billion odd. And this pension scheme has now moved into surplus. So a lot of old legacy companies are left with these pension schemes. They're effectively funding former staff members, former employees, and they're real burdens. They suck up lots of cash. To give you a sense, Premier Foods will no longer have to fund this scheme. That's going to save them about 33 million a year. And when they were generating free cash of only 55, 33
Yeah,
is a
it's a
big
chunk.
number relative to 55. So that's going to free up that cash to
Mm.
support growth. So it's a big deal, this, and it's moved into a nice surplus, 961 million. It's interesting. I looked at the pension schemes holdings, albeit most of them are now in fixed income and gilts and very low risk, but there was absolutely zero exposure to UK equities at all. They did have some overseas equities, but no exposure to UK equities.
Yeah, so a UK company that sells well-known UK brands in the UK market, but yet doesn't have any UK companies in its pension portfolio for its UK employees. It's a shame, isn't it? So,
It is a shame.
should we move on to ITV then?
Yeah, another well-known name. It's a constituent of our income boosters portfolio, a dividend play, and it's been struggling with advertising spend. It's also flogged its BritBox share of its BritBox, I think, to the BBC for a decent sum. 50% stake in BritBox. It got a good price for that, and it's saying the cash it's getting, 255 million, it's going to devote through to a share buyback. I'm not convinced about that. I think it might be better to reduce its debt, but it seems to be comfortable. It's got this big hit, Mr. Bates versus the Post Office. That should have done its credibility quite a lot of good. But it's just this transition out of from traditional media like the ITV from an advertising perspective to digital that's hurt it. But the studios business is doing well. But yeah, ITV not quite the business it was. The shares have been down and out. They bounced a bit on these results, and let's hope it's onwards and upwards a bit for ITV because it has been struggling a lot over the recent years.
Yeah, and I'm not too sure how these can compete with the likes of YouTube.
Agree. It's a tough space they're in. It is
I
a tough
mean,
space.
that landscape has changed so much, hasn't it, over the last 10 years and accelerated in the last 5.
But you
You know,
can see if they do produce a quality production like Bates versus the Post Office, how well it can do. And that was exceptional. I don't think a TV program has had such an impact on politicians as this one has, and had such
oh,
an immediate reaction. So there is a space. It's just how can they repeat these kind of
yeah.
achievements?
But the cost to produce those shows, this is the competition of anybody with a microphone and a camera can set up a YouTube channel. And I'm not saying that anybody can achieve great success, but you look at some of the big YouTube channels, Mr. Beast as an example, they're competing with these people.
My family was talking about that only yesterday. I'm not familiar with it, but you named it. They were talking about it. How often people talk about a TV show. Post Office was a rare
A
occurrence
rare
when they're more
occasion,
often
yeah.
going to be talking about Mr. Beast.
Yeah.
And
You don't see people walking around with ITV t-shirts.
that's the problem.
Yeah, I just
You
think,
even see people walking around with Greg's t-shirts on
yes, you do.
Primark. I
Yeah.
mean,
I think that's an old medium, and I think it's always going to struggle. I just,
they're in a tricky spot.
yeah. Before we move on to AIM, shall we talk about AIM's more successful company that most people perhaps have not heard of?
Yeah, there's a certain company on the main stock market that people may have forgotten that ended up on AIM, and it reported this week. And it's worth reminding people that AIM can be the sort of seedbed for some interesting businesses. The business is Melrose Industries, and it started life on AIM in 2003. It didn't stay there long. It was just used it as for a listing, and it moved to the main market a couple of years later. It started life as a £10 million business. Its founders had this concept of buying, investing in, and divesting engineering companies. That's its focus, the engineering sector. And it's been pretty good at it. Its market capitalization now is 8.37 billion, and it's already returned 8.2 billion to shareholders. So its numbers are fabulous. There isn't another AIM company that's delivered these kind of numbers. Its start was on AIM.
You should have had that in a bit of a bio into the letter when you sent it to the London Stock Exchange.
Yeah, maybe missed the point there.
Started out at 10 million, now it's worth 8.7 billion.
Fantastic.
That's
Fantastic
unfair.
achievement.
So yeah, should we move on to AIM then? Science in sport.
Yeah, science in sport. It's a well-known brand name. It's been on AIM for a while. It's never made a beam, never made any money. And management have finally, the new management team of pennies drops, as we said, that realize that they can't keep pursuing top-line sales growth. They can't just keep throwing marketing money at stuff, and they've got to try and make a profit. And so they're reviewing everything. They're cutting costs, and hopefully we'll see this business actually turn profitable. I think there could be a good recovery story in here. But I'm worried that it's a pretty niche brand, really focused on high performance athletes, professional sportsmen to whom they are aligned. That's the core science in sport brand. They've got another brand called PhD. But yeah, the market cap's 28 million, their revenues are 63. So if they can, even if revenues fall and they can make a real profit and demonstrate that's repeatable, and they've got some loyal customer loyalty and real brand loyalty that doesn't depend on giveaways all the time, there might be a recovery play here. But I think management's got a bit of work to do.
When the marketing
Yeah,
money dries
yeah.
up, we'll find out how much loyalty have they actually got.
Yeah, I've seen people say what a great brand it is, but I don't think a brand's great unless it can make a profit. The brands have got to be profitable. Great brands that are profitable can stand on their own 2 feet. If not, are they really great brands?
Yeah.
Are they commercially good brands? I'm not convinced.
I've done a lot of trading myself and I've used their products, and I just tend to use all natural now. I don't bother with anything. Don't bother with protein, sports bars, anything. I just trade and use foods. And
I think a lot of people are going that way, aren't they?
I think we're
I think
moving into that direction. I do.
it's their
I
main
do think that's
competitor as well. That is
yeah,
Science is Sports' main competitor, I would have thought.
yeah. I think that's the trend. I do. I think that's the trend. I think everything's going more natural. Yeah. Shall we move on to another company that's actually doing rather well overseas?
Nichols soft drinks business, it owns the Vimto brand. Been around since 1908. Founded in Manchester by John Nichols. Been around a long time. He was a wholesaler of herbs, spices, and medicines, and he saw the market opening for soft drinks due to the temperance movement, the passage of the 1908 Licensing Act. I love that. A man that spotted an opportunity and went for it big time. It's been a great business. It just lost its way over recent years. It started doing all sorts of other things, focusing seemingly on all sorts of other areas other than Vimto, which is its a true iconic brand.
Mm.
Absolutely fantastic. It's had this outer home business that was dealing with dispensing all sorts of other things. That's been total disaster and resulted in huge amounts of impairments and write-offs and restructurings. But in the meantime, the core Vimto brand is growing great guns. Middle East has always been strong. It's a big supporter in Ramadan. It's 100th Ramadan season in 2023. It's got a really good market strength there. Revenues in Africa were up 17% to 22.2 million. You need to know what you're doing to be growing in Africa like this. That's on top of 15% growth the prior year. It's great business. Who would have thought this is possible? They're a brand that was started in 1905, 1908, and is going like this. UK is a bit static, but international seems to have a great, opportunity. And loads of innovation, lots of new flavors. They constantly innovate. They try to get people to have a try me hot marketing campaign, drinking hot Vimto in the winter months. Yeah, good stuff. They got a new Vimto energy product. Into the energy subsector. Does that start attacking science in sport as well? But yeah, don't forget Vimto is absolutely loaded with cash as well. One of the most conservative balance sheets you find. It's got 60 odd million quid of cash. So it's making loads of interest on its cash as well. And it's got tight grip over it. It doesn't want to spend unless it has to. And it has been spending in the right areas. But if the out of home business can be got rid of when it's on a more stable footing and the focus can be just on Vimto, I think there's a nifty sort of recovery story there. Great stuff.
It's good to hear a UK company doing well as well, and internationally as well.
Yeah, I should add as well, we've held Vimto and we've held Nichols on our AIM portfolios. That's fundamental for some time. It's been a long stalwart of those, very steady performer and a nice solid business.
What's the dividend?
I think yields about just shy of 3%. and there's opportunity to accelerate that. I think this business could be delivering upgrades in the current year. I think there's the potential for it. I think it'd be in good shape.
Brilliant. A couple of takeovers that you want to mention in AIM as well, isn't there?
Yeah, one's a Mattoli Woods, another private equity investment management backed takeover. Mattoli Woods is a specialist alternative investment manager being acquired by funds managed by another alternative investment manager. Disappointing if AIM loses another company. It's $400 million takeover, a big business, big dividend payer. It's on our fundamentals AIM income portfolio. As it because of its dividend attractions. It's been very acquisitive, been acquiring lots of business. Its founder, who's still got a 6% stake, thinks it can do better off the stock market in the hands of private equity, which I think is a bit odd given that the stock market injected £100+ million into it a few years ago. So it have been clearly very supportive. A little bit of patience, it could do fine. The other one is Spirent Communications, offered another premium. Premium was 60% of the share price the day before, but if you look at it, the share price, the price is still well down on previous highs, massively down, and even well down on where the shares were regularly trading a year or so ago. So the premium at first glance looks good, but really, is it that good for people that have been in this for a while? There might be a sort of relief for this takeover premium, but investors just lack patience. I think these businesses will deliver over the longer term. They're just in a bit of a slump at the moment in terms of the interest in them.
So does the Mattoli founder, does he think that the company is undervalued then, the reason he's taking it private equity, or does he think that it's not being rated out fairly by the stock exchange?
I think that's the latter point. I don't think he thinks the rating should be more, or he thinks that things he's trying to do on the public stock markets, make acquisitions, won't necessarily go down that well given the costs of doing that. I just think people need to be a bit more honest. A lot of them, the way they report nowadays, they adjust things. And if they communicate things better, I think people will continue to support them. He's clearly lost patience. Maybe think it's going to be an easier life growing in private ownership as well off the stock market. They won't have to do reporting and issuing
Yes.
RNSs all the time. They won't have those demands, investor meetings and all this communication lark. You just get on with trying to run the business and grow without the reporting.
Do you think that's a bit of a headache for the founders and the companies when they just want to concentrate on growing the company?
I think some have, but this has been around for a while. The aim has been pretty good for
How
it.
long's
I
a while?
think.
How long's a while,
I
roughly?
don't know. Has it been listed about 15 years or so? More?
No, it has been a
Well,
long, yeah, it's a while,
I, th- I
isn't it?
think, and as I say, they gave them £110 million in 21 to go ahead and
Do
do
what
the
you need to. Yeah,
acquisitions.
yeah.
The price being paid now is only 21% or 20% above what investors injected in that 110 million. 2 years on from investing that money, which is a lot of it still there, hasn't been spent. Are you going to be happy with this premium? We'll see what the reaction is from these outside holders.
Yeah.
The other problem is where you're going to, this is quite a nice business. Increasingly, where are the big holders going to reinvest their money, particularly those that need to reinvest in AIM shares, say those that are investing in it for inheritance tax planning, they need to stick on AIM. You keep losing high quality businesses, you're forced to invest in lesser ones. It's not a great scenario.
So I've got a knock-on effect, hasn't it?
Yeah, yeah.
We need more AIM companies, Chris.
We do my best.
Yeah. We're going to finish off with something we touched on earlier, which was subscription companies. And there's a list of companies on AIM that people may or may not be aware of that are subscription based, but they do have their pitfalls as well, don't they? So it's not all cash flow just pouring in, is it?
No, I love subscription-based businesses which have lots of reliable revenue, where the subscribers are almost forced to keep paying up year in, year out because there are no other alternatives. They're absolutely fantastic, where you're really embedded in. And we mentioned one, Sage Group is a fantastic subscription-based business. Accounting, you don't want to move really, unless they really mess up. You don't want to move. And we put an article out on subscription-based businesses this week. One of them's Craneware. It's US market facing. One of them's Dot Digital. Another one called Quartix, another one called Beeks Financials. You can see the whole article's there. So they've all got these sort of subscription models, which often entail, if you're at the early stage, paying out a lot for investment of your product, and then you're going to get the money back over years. But once you're embedded into them, if you look at the detail, the amount of money that has to keep going into keeping these platforms alive, keeping them fresh, keeping the new features, piling into marketing, it's a tough old business. And what the top end, Craneware, worked out, it quoted an R&D number, research and development figure, that was about 25% of its revenues. This is quite a well-established company now. And again, the other thing to people listening to us should be, and who are interested in these businesses, when they're researching them, I would implore you to look at the free cash flow, because you don't get the full picture looking at the earnings, the income statement. You've got to see how much cash they're paying out and how they're accounting for things. Quartix is really prudent. It writes off everything. So it writes off all its research and development. So its balance sheet hasn't got many intangible software assets at all. Whereas at the other end of the scale, Dot Digital capitalizes a lot. So you can see in the cash flow how much it's paying for stuff each year. It's a tough old business. These things cannot sit still. They keep having to reinvest, and look at the free cash flow. This move to the cloud as well is costing them, a lot of money, especially those that were a bit behind the curve. They're now having to catch up and pay for their cloud positioning. It's not as easy as it looks. Beeks Financial, which provides hardware, I think its term is infrastructure as a service. So it's putting a lot of hardware into data warehouses and close to exchanges. So even that's a different derivative of this SaaS model. I'm not averse to a subscription business that buys a long-term revenue stream. I think it's worth playing into money. Going back to science and sport, it was playing a lot into marketing for potentially very short life customers. It's worth spending, I think, for long life potential customers to become embedded that don't want to leave you. And I think subscription businesses have more justification for that than others, but it's how sticky the customer really is.
Yeah. And I think as well, companies that are in a position where customers are selling their business for them. We mentioned Howdens, didn't we? Where the joiners, they were selling Howdens on behalf of Howdens, even though they weren't employed by
It's a brilliant
Howdens,
model.
because they were so much easier to fit for the kitchen fitters.
They had a
They had
sales
an
force out there. They weren't even paying for
They
it.
weren't even paying for.
Yeah.
And like I mentioned earlier with science in sports, I do a lot of training in gyms. I see a lot of people talking about grenade bars on how nice they are. And that's what people using and eating in gyms. There's people in the gym talking about how nice grenade bars are. Guess what that person hearing that goes and buys? A
Yeah.
grenade protein bar. So, I mean, the best sales is to develop something that your customers are out there selling it for you. If you get that, you've nailed it, haven't you?
And such strong brand value as well.
Yeah.
There you've got a real brand.
Yeah, you've got your sales team for you out there, and they're your customers.
No incremental cost for you. She's
So-
perfect.
If people are enjoying this podcast, they're hopefully telling their friends.
I hope so. I think we covered some interesting stuff. I mean,
Yeah, we'll find out if people are telling other people about it. Should we leave it there?
yeah, excellent. There's always good fun.
Thanks, Chris. Enjoyed it. Thank you.
Thanks
Bye.
very much.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.